Let me kick the video off with a bit of wisdom. There are two things in life that are guaranteed to happen. Number one, unless Elon Musk transforms us all into robots, we're all going to pass away eventually. And number two is the fact that we're all going to have to pay our taxes. Well, at least if you want to do it the legal way. And that's why in this video I want to talk about the topic of taxes, especially as a European investing in the US market, which for me is the most attractive stock market in the world to invest in. And I know a lot of you watching are maybe not fully invested in the US, but have a big part of your portfolio invested in US stocks. So despite this being a rather boring topic, nothing exciting to pay taxes, I do think it's super important to really understand what kind of taxes you are looking at when you invest in US stocks, especially from a European perspective. So essentially, you're going to be looking at three main taxes you're going to be paying if you invest in US stocks. And the number one tax, and that's probably without a surprise, is the capital gains tax. So that's basically when you buy a stock, let's say Apple shares, you bought it for $1,000, it goes all the way up to $1,500, you want to sell it. The difference from what you bought it for to what you're selling it for, the $500, that's exactly what you're going to be paying taxes on. Now the great thing here is the US is actually not taxing you on any of that. Any capital gains you made in the US are actually tax-free. However, of course, wherever you live in the world, most likely you're going to be having to declare this capital gains in your country of residence, and you're going to be taxed on it unless you live in Dubai or other parts of the world where there's no capital gains tax. And some of the countries do have an exemption, but most countries in the world, they're going to charge you capital gains tax. Depending on where you live, it might be a different percentage, but the US is not going to be charging you any capital gains, and that's great to know. And then we also need to differentiate between short-term capital gains and long-term capital gains. Now that's applicable to pretty much most countries around the world. Short-term basically means if you sell any stock or security within a time frame of less than 12 months. So if you buy Apple, it goes up, and a month later you sell it at a profit, most likely your short-term capital gains is going to be a higher percentage than if you held it on for over 12 months. Let's say you sold it after 2 years. Those $500 profit you would make on Apple, for example, would most likely be taxed at a lower rate because that applies to long-term capital gains, right? That's usually less than short-term. So that's kind of for day traders more relevant. Those people who really frequent traders in and out of positions, they pay usually a higher tax than those who buy and hold for the long term. And that's why I also do buy and hold for the long term, because usually the tax you're going to pay on that is significantly less, which is obviously nice. There's also something called tax loss harvesting, basically where you offset some of your gains with some of your losses. So if you happen to sell and exit a position that you don't believe in anymore, the stock price dropped so much and you're really not confident about the future of the company anymore, and you want to cut your losses, let's say you lost $500, and as I said in the previous example, with Apple where you gain $500, there are certain countries in the world where you can net off your losses with your gains. In this case, basically you would have a net zero and wouldn't pay any taxes because what you lost with one stock, you gained with another, and in total, the difference is what you're going to be paying tax on. So that can really help you to reduce your tax burden. Now, of course, an important question is always to understand where you actually have to pay your tax, because in the world we're living in, it's very easy to move around, live in different countries for a month here, for a month there, freelancers. It's easier than ever to live in different countries. So a general rule of thumb is basically any country where you live for more than 183 days, the 183-day rule, basically that's where you're going to be having your tax residency, and most likely that country is going to tax you on your income. So be very mindful of that, keep that in mind. So even while it can be tempting and very easy to set up residency or a company in Dubai and get zero interest on your income or capital gains, etc., if for most of the year you still end up living somewhere in Europe, Germany, UK, etc., they're still going to make you pay the taxes in that respective country. So do keep that in mind when filling out your taxes. And of course, all the things I'm talking about are from a non-American citizen perspective. They actually call it NRA, non-resident alien. And yes, they actually do call us alien. The second big tax you need to know about is the dividend withholding tax. So basically, when you buy any dividend paying stocks in the US will automatically withhold 30% of those dividends that are owed to you. So let's say you qualify for dividends from Coca-Cola worth $100. The US will automatically take 30%, which is $30 of your dividends, and keep it with them. And that won't even reach your broker. So that's really something to keep in mind, because that can obviously really reduce your overall returns. You get something very important for many European countries and other countries around the world. They do have a tax treaty with the US that allows you to reduce this number quite significantly from 30% in most cases down to 15%, which really is a significant saving and increases your profitability. So in order to qualify for the reduced withholding tax of 15% in most countries, you have to fill out what's called a W-8BEN form, and this will obviously reduce that withholding tax. And most brokers actually will help you to fill it out, especially the brokers that I recommend and use myself, Interactive Brokers, Trading 212 and Lightyear. They actually help you with this. And for myself, that's why I'm only paying 15% dividend income tax on my US dividend income, which is really a nice saving and definitely makes a big difference, especially as it grows over time. And if you want to check out any of my brokers that I use myself, you can use the link in the description below and you're going to get a nice sign-up bonus if you sign up to any of those. Serious question. What do you call a superhero who doesn't pay his taxes? Spider-Man, because all his income is net. And lastly, a very important tax that you need to know is the estate tax. Many people actually skip over the tax, especially when you're young. It might not really apply to you, but as your portfolio grows, this becomes ever more important, especially for later generation and your family. Because essentially, if you're an NRA, a non-resident alien, basically not a US citizen, but you end up having a large portfolio in the US, and God forbid, many, many years from now, you will pass away, then the US government will actually take a huge cut. More precisely, it can be anywhere from 18 to 40% of your intangible and tangible assets that you have in the US. It can be any shares, stocks, bonds, real estate that you have over there, and that will be taxed depending on what it is exactly, anywhere from 18 to 14%. So that's a huge number that you really need to keep in mind. Obviously, the older you get, eventually you need to think about succession. So for many of us watching, it might be still a little bit early on. But as I said, later on, many years from now, as you get older, your portfolio grows, definitely it's something to consider. And this is a good thing. You can actually start gifting some of your portfolio to your children or offsprings or anyone in the family for that matter, or anyone that you'd like to give your money to. And currently you can do that up to $170,000 per year, which obviously is quite a nice sum, quite generous. And if you do this with your entire portfolio, eventually you can avoid having to pay any estate tax, or more specifically any of your family members who otherwise would have to pay that tax. Now obviously that's a very generic video about general understanding of taxes. I mean, the whole topic is so complicated. That's why there are people, companies around the world just specializing in tax, because it can really get overly complicated depending which jurisdiction you live in, and so many rules and exceptions. Every country has a different tax understanding, tax treaty with different countries. So it's super, super complex. But I do think it's super important to understand those three main taxes that are relevant for US investors who are not living actually in the US. Obviously, there's so much more to it. You have to understand your local taxations. I can't make a video on every single country, but I do hope this video gave you a good understanding of what to expect if you invest in US stocks. Next up, check out this video over here. If you enjoyed this video, please give a like, subscribe to the channel. It means the world to me. As always, guys, stay healthy, get wealthy, and I see you in the next one. Ciao.